Hey everyone, this is Rahul with the Alternative Investors Hangout, and today we have here Jordan Roy Byrne. He's over at the Daily Gold. I like following his work. It's not sensational compared to maybe some other channels out there, and it gets to the point. Anyways, thanks for coming on, Jordan.
Rahul, thanks for having me. It's my pleasure, and thanks for the nice introduction.
Yeah, I don't know why some of these guys want to attack you for some bizarre reason. I was reading something the last month, but I'm not going to get into that. But anyways, gold and silver, this is the asset class that a lot of investors did not like in 2013, and I'm looking at the charts. We've seen a double bottom when it comes to the lows, one I think at 1179 in June, and then if you want to look at recently, I think must have been in December-ish, where gold hovered around 1181, may have been tax loss selling because of that. But if you notice the volume in June, there was a lot of selling pressure. In December, there wasn't that much selling pressure. So how do you see gold? And then we could talk later on about silver.
Well, there's a lot there. I mean, first of all, I'll try and do a very quick comment on the double bottom, because we are seeing double bottoms show up on a lot of charts. Now, this pattern isn't a typical double bottom, and the reason is a double bottom is it kind of happens like, think of a pop fly in baseball. Like, the market goes kind of straight up, and then it comes straight back down, and then it has an explosive rally off that second bottom. And there was just too much in between the two bottoms. There was too much back and forth action for it to be a double bottom, in my opinion. And I don't think we're in position to really explode off the second bottom. I think looking at gold and silver, we're more likely to kind of see more of a basing type bottom, a kind of a slower type bottom. But if I'm wrong, then it'll obviously be very good for both the metals. That means they'll rebound aggressively here, but I don't see that happening. So would you like me to you want me to stay on the metals, or should we talk about the gold stocks?
Yeah, we could talk about gold stocks.
Well, okay, here's kind of how I see things here right now. In December, I was really thinking we were going to get this final plunge in precious metals, and it just never happened. And if you look at the gold stocks, they were able to – they made a new low in early December, and then they tried to make a new low 2 or 3 times and failed to do so. And also in December, that's tax loss selling season. So it was really a ripe time for the stocks to make new lows. Again, to repeat myself, the stocks did not make new lows. And, given how oversold everything already is and the negative sentiment, I think that's very, very encouraging. And in addition to that, I checked last night when I was doing a premium update. Of my 15 favorite mining stocks, 13 of them did not make new lows. So 13 of these stocks bottomed in late June, and actually 4 of those, I think, bottomed before that. So, and those are mostly junior producers, some development companies, some exploration companies. So what these things kind of tell me is that, the market has already begun a bottoming process. The stronger, higher quality stocks with real potential, they've already bottomed. And then the market itself tried to make a new low last month, and it didn't happen. So that's very, very encouraging. Looking at that and just looking at the other things, if I had to guess, I think the bottom is in. But, again, I could be wrong. But I think, more than 50% the bottom is likely in. Now, looking at the metals, what's very interesting is gold did make a new low in the last couple of weeks as far as its daily close and weekly close. It did close at a new low, but that was not sustained. Gold quickly reversed back up, and last week gold had a wild week. It tried to make a new low, and it ended up closing the week very strongly, closed at a 5-week high. Now, silver unlike gold, silver never made a new low. So silver bottomed in late June, and last week silver tried to push lower like gold. It did not. Closed the week very strong at a 7-week high. So, I mean, looking at all these things, I think the short-term outlook is definitely bullish. And it's difficult to say that because when you're deep into a bear market, everyone is so badly bruised. They think the bottom is coming, and then maybe you get a little rally, and then you get a move to a new low, and then at that point people are, they're still saying, we're close to a bottom, but we're not there yet. And so I anecdotally, I see a lot of people thinking that, we could have one more move down, and I was in that camp in December, but at the end of the month, looking at how things were developing, I changed my mind. So I know that's a very long answer, but right now, I do think that, more than likely we have bottomed, and I think the short-term trend is going to be higher. And to conclude this long answer, I'm not quite sure we're going to explode higher right away like we typically do out of bottoms. So, I mean, that's kind of my thinking. I think it could be a month or two before we start to get a stronger rebound. But I'm definitely bullish in the short term, but cautiously bullish, I guess, or slightly bullish, I should say.
You showed me some charts. It must have been sometime last year, middle of last year, and you showed me how from 2008, silver had a similar ride of what happened of the price movement in silver in the 1970s, where it went up and then you had a slight correction, and then based on the chart you showed me, you think that silver is going to have a spike like you saw in the 1970s. Do you still agree with that graph that you gave me last year?
Well, I think when I gave you that graph, that was in the spring, and so silver, I think it was trading in the mid-20s, and so the fact that silver broke down, it kind of busted that chart, but it was trading very closely to that correction for about 2 years or so. But I do think the reason why I think we're going to get a spike looking at these markets is because we know that commodities tend to spike, and that's how they end. But it's been almost 3 years since silver peaked at $50. Silver is not going back to $50 for a while. I mean, but look where we are right now. I mean, silver can end the year at $35, and that's like almost 100% gain. So it's going to.
Sorry to interrupt you. Like when you say for a while, what's your time horizon? Because some people may think that 30 days is a while. I'm not saying it's going to be 30 days.
Well, that's a good point. I mean, I don't have some of my analog historical charts in front of me, but I would say when is it going to break above 50? Definitely not going to happen this year. Probably not going to happen in 2015. I would probably say 2016. And so, Raul, if that's the case, then that means, let's just conservatively say, by the time silver breaks above $50, it's going to be 5 years. And a similar thing actually happened in the 70s, where it made a low in 74, and then I think it made a high in 74. I think it was, what was it at, $6 or so, $6 or $7. And then silver did not surpass that until 1979, which was 5 years later. And looking at gold, it's already been, we're about, 2.5 years or so since gold peaked. When is gold going to break above 1900? I'm not sure. I would say maybe at the end of 2015. So, I mean, looking at that, it tells you that, okay, so 5 years for silver from the peak to the next breakout, and for gold we're looking at least 4 years, probably 4.5. I mean, that's a long time between these peaks. And so, assuming I'm right and that happens in a couple years, I mean, the market is going to build up a lot of momentum to get to that point, to get to the breakout. And after that breakout, that's when the really sharp move is going to happen. And if you look, that's what happened with gold in the late 70s, where it took gold 3.5 years between the highs to make a new all-time high. But when it made a new all-time high, I don't quite remember if it happened in 78 or early 79, but after it made that new all-time high, there wasn't that much time between that point and when it really started to go parabolic. So, I mean, I hope I'm not getting off topic here, but that's kind of my view, is that I think the parabolic move is going to happen sooner than people think, and it will happen not too far after the next time when we make new all-time highs.
All right, moving forward, I wanted to get into the Dow. The Dow, as of December 2013, the high must have been around 16,600, around that range. And you were actually one of the few bears that I follow that think that we're in a secular bear market, as Warren Buffett stated in 1999, and you believe that the Dow is most likely going to go 30 to 35% down. A lot of my subscribers and a lot of people I talk to don't agree with that. So what puts you in this camp?
Well, there's a lot of things that put me in this camp. First of all, I think the bottom that we had in 2009 is going to be similar to the bottom we had in 1942 and 1974. I mean, let's look at the secular bear markets that we've had. We've had three. I just spoke about the last two there. Now, looking at the one from 66 to 82, the market bottomed in 1974, and it didn't make a valuation bottom until 82, which was 8 years later. So valuations in the late 70s were not that high, but even though the market bottomed in 74, if you look at the charts, it's clear that the secular bull didn't begin until 82. And the reason that is because in 82 you had a very, very low PE. I mean, what are stock prices based on? They're based on earnings and then the valuation. So secular bull markets start when the valuation is really, really low, because then it has lots of room to rise. Now, if you go back to the 40s, the market, you could even say the market bottomed in 32, but most people say the market bottomed in 42, had a really good rise to 46. But the problem is, in 1946, the valuation, looking at the S&P then, because I like to follow that more than the Dow, the valuation was like about 20 times trailing earnings. Where are we right now? We're at 19 times trailing earnings. And from 1946 to 1949, the market corrected about 28%, and the PE ratio came down to under 10. So companies still did okay in that period as far as their earnings, but you had a major valuation compression, and then from 1949 to the mid-50s, you had a really, really good rise because profits were going up and valuations were going up because there was a lot of room for them to go up at that time. The same thing happened from 82 to 87. So the problem is, where are we right now? Well, we've had this really good rise. We're, what are we, four, almost 5 years off that bottom, but the valuation is 19 times trailing earnings on the S&P, and it really needs to come back down to at least 10 or under 10, and because that's what happened in the last two cycles. And again, so you had 1942, the market made a low. 7 years later, you had a valuation low. 1974, excuse me, market makes low. 82, you have the valuation low. After 82 was when stocks really took off. After 49, stocks also really took off. Commodities peaked in 1951. So to get us back to today, 7 to 8 years between those points, that tells you that the market could make a valuation low 2016 or 2017. My guess would be 2017. So we're in 2014 right now, and so I think, why are we not going to have a 50% decline? Well, there's actually more people who think that's going to happen than there were a couple years ago. But if you look at the end of secular bear markets, you don't tend to get a crash. The bear market that you have is usually associated with inflation. This happened in the 19-teens. It happened in the late 1940s. Happened in the late 1970s. So you get a bear market, a cyclical bear market that's usually associated with inflation, and it usually takes several years. It doesn't happen quickly, and it's usually not as severe in price as the first couple cyclical bear markets in a secular bear market. So those things being said, I think the outlook over the next 2 to 3, 4 years for U.S. stocks is not good. I think we're definitely going to be trading lower. And if you look at if you look at these long-term return models that, the CAPE ratio that Robert Shiller uses and Jeremy Grantham, and they're looking at, where a return's going to be 5 and 10 years from now. I mean, the forecasts are abysmal. Some say 0% returns, some say 1 or 2% returns per year. So, where the market is right now, maybe it can continue to rise for another 3 months, maybe even 6 months. But, beyond that point, the outlook over the next couple of years is just not good at all because valuations are too high. So, I mean, to get back, are we in a secular bear or not? It really depends what you're looking at. But my conclusion is, to sum it up, the bottom in 2009 was similar to the bottom in 1942 and 1974, but the true bottom as far as valuation is not going to happen until probably 2016 or 2017. And by the way, looking at history, after that bottom, that is when U.S. stocks perform fantastically over the next 4 or 5 years. So, I'm kind of looking at all these things. We could see a resurgence in commodity prices. We'll get some inflation over the next 3 or 4 years. Then when that peaks out, stocks will have bottomed. PE ratios will be super low, and then stocks will begin a true secular bull market. So I know that's a long answer, but there you go.
All right, I just want to point out a few things. Those listening at home, just remember to do your own due diligence or go to your financial advisor whenever making any financial decisions. Just had to throw that out there. But responding to what you were saying, you said that secular bears end in inflation. So do you see then oil prices spiking up because of that? Because I've looked at some charts of oil, and there are some individuals stating that, hey, oil could go to as high as $163 a barrel. And when I see something like that, it goes along with your thesis and what you're saying. And in addition to that, you have to look at the fact that we're having an election time. You usually see markets go down after a spike up. And then thirdly, what I've also noticed is that when you see higher oil prices, the stock market also tends to go down with that.
Yeah, that last point is very excellent, because a lot of times oil spikes, it causes a recession. And so that, that's actually how it's happened several times, where we've had 3 secular bear markets, and the end of 2 of the 3 has happened because you have a spike in commodity prices. You had a spike in commodity prices in 1920. Then you had, what people call a 1-year depression. The spike in commodity prices and inflation that caused that depression. And then, of course, the late 70s. And that could happen this time around also in the coming, next 3, 4, 5 years or so, where you get a spike in commodity prices, and that would include oil to some degree, and that causes a recession, and maybe that's what that ends the commodity bull market, and maybe that's when stocks begin to rise again. But with respect to oil, I don't have expertise in that area, so it's difficult for me to say. Excuse me. Looking at commodities, I do think we're going to see a revival in commodity prices at some point this year. We've really, just looking at all my sentiment indicators and looking at the technicals on the CCI, I'm very confident that commodities are going to probably start to work their way higher at some point this year, probably sooner rather than later. The thing with oil is when oil spikes, or when oil rises quite a bit, it's not sustainable. It causes, as I said earlier, it causes recessions. So if anyone's predicting a spike, it's certainly going to have negative effects, but that's going to be temporary. So if oil kind of rises in a more gradual, steady fashion, like we had from 2004 to 2006 or early 2007, then the markets can handle that. But when it starts to rise aggressively, that's when it starts to mark trouble for stocks and other assets.
Interesting information, Jordan. And before I let you go, how can people follow your work again?
They can go to thedailygold.com.
All right, yeah, and I recommend you guys just to check it out, just to get a different type of opinion, because I really like following him on Twitter. All right, thanks for coming on again, Jordan.
Thanks for having me.